Hi, everyone. Mike White here. Welcome to this week's blog post. The data keeps coming in and it keeps sharing really what I think is important information. And it shows that people, especially millennials, the largest demographic group in the country, are really still interested in home ownership. And despite higher prices and higher interest rates, loan applications are still relatively strong for home purchases. Again, we know that refinances have tailed off significantly, but there's still quite a few refinances being done even at today's higher rates. But the purchase activity, people coming in to be pre-approved, people filling out loan applications, still very solid. And while we're dealing with, applications that are about 10% off of where they were this time last year, it's still a far cry from what people would have you believe on social media and on TV. Those experts calling for the fact that, the mortgage industry is dead and nobody's buying houses and we're, dealing with all kinds of mayhem. Now, I get it. Those companies and those individuals who were heavily weighted into refinances, certainly are facing their challenges, and our loan volume in total is significantly off where it was. But again, last year, 60, 70, 80% of the business in some companies and with some people were refinances. So to have that business fall off by 70 or 80% is going to leave a mark for sure. And I get that there are, significant numbers of layoffs, across the country for mortgage companies. But the reality of it is, we had, a huge last couple of years, people staffed up to handle a extraordinary amount of volume. But in the big picture, we're looking to be on par for, a significant number of purchase transactions, especially mortgage related purchase transactions. And I think, there should be no surprise in the fact that home ownership is a real thing, especially because rates on rents continue to climb at a significant pace. And let's be honest, these millennials are coming into the market and they're thinking about home ownership. Over the last 10 or 20 years, creation of new housing units has significantly been under new household formations and new people coming in. And so the cumulative effect of their new units not being constructed, and certain migration patterns, the ones that we know about anyway, are putting tremendous pressure both on the rental market and the housing market. Now, housing prices, home prices are up 14%, almost 15% from this time last year, which is down significantly from the 18 to 22%, depending upon your market, where prices were escalating last year, but it's still significantly higher than the projected 3 to 5% price appreciation. And let's be honest, 14 to 15% appreciation is not a housing bubble. All the claims of a housing bubble, all the claims of, oh my God, foreclosures, all this stuff. And I don't know where they get their information, but the fact of the matter is foreclosures are at a 40-year low. Most everybody that you can find, even if they're in a precarious situation, would sell their house and take some of the equity that they were there to at least leave the home and move forward, either paying off bills or being able to give themselves a start, because you can't find many markets where there isn't a significant amount of equity in the properties that are out there. So again, supply is still under pressure. We talk about this is if all these people didn't want to buy houses or whatever, wouldn't supply be going up? But it's going down. We're seeing some cases where houses came out on the market and they came out on the market, 20% higher or 10% higher than what the last house in the neighborhood sold for. And people aren't jumping at that number. But these houses are still getting sold, and they're getting sold for at or above where the last guy sold for the comparable house. Some of these things, and I've seen it in my own neighborhood, where people come out with outlandish prices on houses, they throw it up there, and you watch them, play the game and come down. But if you, like, I have software that appraisers use in my computer to understand values and condition, I see people come out $100,000, $200,000 higher than what this house, should really comp out at. And by the time they go into contract, they're still $10,000, $20,000 higher than what the median comp would have been. So I don't see the housing market softening. There's still this demand. Everybody's got to live someplace. And as long as rental pressure is out there, with all these people trying to find these rental units, some people actually getting into bidding wars, paying more money than what they're asking in rent, we have to pay attention to the fact that, that there is this pressure. Now, we've had a few solid days in the bond market. We stabilized, hopefully, a little bit. Yesterday's 20-year bond auction went really well. I'm hoping that this further helps try to stabilize where we are, at least give us a range and calm down with some of that volatility. Now, I'm not saying I think rates are going back to 3, but I'm also in a position to watch the market and understand that the market is adjusting to conditions, and maybe the Fed will hold true on its, on its path, and maybe they will continue to raise rates, and there will be confidence that the long-term bond market is something that can be counted on, which will help stabilize us. But we're a long way from seeing where back to normal is. And in fact, I'm not even sure exactly what that word means. But hopefully we've taken some of the volatility out of the market. And I'll say this, and as soon as I post it, the market will go absolutely nuts this morning and we'll bounce all over the place. But again, we're only as good as what the next report is. And we're going to deal with an unemployment number, again, looking in July, we got the June jobs report. We're going to deal with the second quarter inflation number, which could be a huge trigger. These are all things, all data points that we're going to have to deal with. But again, understand that it's not about where interest rates are. It's not about what the house costs. It's about what the payment is to the customer. It always comes back down to paying attention to the fact it's not about rate. It's not about price. It's about payment. It always has been about payment. It's been, how much money do I have to bring to the table? What are my monthly payments going to be? That's always been what we do. And many, many, many people in the mortgage industry and the real estate industry do not understand that. They're focused on the wrong information. The reality of it is we've got to focus on what those payments are, what we can do to help alleviate some of the payment pressure by improving credit or looking at programs or allocation of assets, because that is the underlying factor. And again, this market's not coming to a screeching halt at 5 or 6%, because again, I know plenty of people, myself included, who got into this market and spent many years doing loans in double digits, and there was plenty of business to be done. So understand what's going on. As always, if you have any questions or comments, it's Mike at imtcoaching.com. We'll talk to you again next week. Take care.